Imagine waking up to find that the silver you held as a safe haven has suddenly been locked behind a wall of new, mysterious regulations that no one saw coming. Just as the sun rose this morning, a shockwave hit the global bullion exchanges, not because of a sudden drop in demand, but because of a calculated overnight rule change that has effectively frozen the market in its tracks. This is the silver freeze, a moment where the rules of the game were rewritten while the world was sleeping, leaving millions of investors wondering if their wealth is still truly theirs. Today, we are pulling back the curtain on this digital iron curtain to understand how a single regulatory stroke has sent the silver market into a tailspin, creating a crisis that could redefine the future of precious metals forever. The global financial community is currently reeling from what can only be described as a coordinated assault on silver's liquidity, a move that has blindsided even the most seasoned market veterans. For years, silver has been the bedrock of the people's macro, a way for the average individual to opt out of the volatility of fiat currency. But the events of early 2026 have turned that security into a cage. On January 30th, the world watched in horror as silver prices plummeted over 30% in a single session, dropping from record highs near $120 to the low 80s, wiping out over $150 billion in value within hours. While mainstream media blamed the nomination of a hawkish Federal Reserve chair, the reality is much more mechanical and calculated. The crash actually began hours before the official announcement, triggered by a sudden, massive 50% hike in margin requirements by the exchanges. This forced thousands of retail investors into immediate liquidation, creating a cascade of selling that was engineered to cool down a market that was becoming too hot for the banking system to handle. As we dive deeper into the mechanics of this freeze, the complexity of the rule change becomes even more alarming, revealing a sophisticated effort to suppress silver's true value. Just as the market began to stabilize in late February, a new set of emergency delivery restrictions was implemented, specifically targeting non-hedgers or retail participants. Under these new rules, smaller investors are effectively blocked from taking physical delivery of their silver contracts, forcing them to settle in cash instead. This is a red alert for the financial system because it confirms that the paper market has officially decoupled from physical reality. The exchange is essentially admitting that while they can trade digital silver all day, they no longer have enough physical bars in their vaults to satisfy the demand. With COMEX registered inventories hitting all-time lows, dropping nearly 75% since 2020, these overnight rule changes are a desperate attempt to prevent a total drain of the remaining 82 million ounces left in the vaults. The climax of this unfolding drama arrived this March as the open interest for silver contracts reached a staggering 500 million ounces, while the actual deliverable metal stands at a mere fraction of that amount. This is the moment the silver world has feared for decades, the realization that there are 5 paper claims for every 1 physical bar. As the news of the delivery freeze hit the wires, the London Bullion Association and the COMEX effectively signaled a soft force majeure, where the right to demand physical metal is being eroded in favor of cash settlements. This is the ultimate paradox of 2026. The screen shows a crashing price, yet in the real world, silver has never been more valuable or harder to find. Industrial giants, desperate for the silver needed for AI servers and solar panels, are bypassing the public exchanges entirely to buy directly from refiners, leaving the public trapped in a paper market that is being intentionally crashed to protect short sellers. In summary, the silver freeze is a wake-up call for every investor who believed that the rules of the financial markets were set in stone. We have witnessed a mysterious overnight shift where regulation was used as a weapon to crash the price and protect the status quo from a physical silver default. While the headlines focus on the falling paper price, the real story is the invisible wall built around the world's most essential industrial and monetary metal. This crisis is a stark reminder that in a world of digital manipulation and sudden rule changes, the only true safety lies in bearer assets, physical metal you can touch. The paper market may be crashing today, but the physical reality is that the world is running out of silver, and no amount of overnight regulation can manufacture more metal out of thin air. If you want to survive this freeze and ensure that you are not left holding worthless paper when the system resets, you need to understand the signals that the mainstream media is ignoring. This is not the time for panic, but for precise, data-driven action that anticipates the next move of the regulatory giants. The March freeze is just the beginning of a larger repricing event that will favor those who hold real assets over digital promises. To stay ahead of these overnight rule changes and find the safe harbors in this crashing market, you need the specialized intelligence that only Signal Scope Market can provide. We track the movements that happen in the dark so you can prosper in the light, offering real-time analysis of these systemic lockouts before they hit your portfolio. Join Signal Scope Market today to unlock the truth behind the silver freeze and secure your financial future in an era where the rules can change in a heartbeat.